Welcome to Raise and Deploy, a podcast dedicated to international investments with insights from the world's leading investment professionals from New York to Timbuktu. Each episode, we bring on a new guest to discuss the trials and tribulations that occur when seeking substantial returns in foreign markets. We cover the full life cycle of an investment, from the moment you contemplate raising capital offshore to the final check cashed on the returns. Today, we sit down with macro expert Howard Kurz of Lily Pond Capital. Howard tells us how he began his professional finance career on the back of a card game before becoming managing director at Lehman Brothers and heading up their multi-markets proprietary trading unit. He discusses cartel involvement in the Latin American debt crisis, the technological changes in the investing world, and how cryptocurrency may or may not play a role in the future of international finance. Let's get into it. Howard, welcome to Raise and Deploy, the podcast. Thank you so much for being on. We've been trying to get this organized for a couple of weeks now, so I appreciate you jumping on. Why don't you, just to kind of kick things off, why don't you tell us a little bit about how you got your start in the industry and what brings you up to today?
Ash, great to be here. Thanks so much for inviting me. Oddly enough, I actually got my first idea about getting into currency trading in university, which in 1979 was kind of a rarefied place to be. I was invited to play bridge with some Wharton professors who needed a fourth, who promised me free beers. One of them asked me what I was doing when I graduated. Told him I wasn't sure, and he said, well, by the way, you play bridge, you should consider getting into currency trading. I think you have a great mind for it. He ended up becoming my senior advisor. I did a thesis on covered interest rate arbitrage. When I got out of school, I really wrote 3 old school letters to the treasurers of Bank of America, JP Morgan, and Citibank, saying that, I wanted to get into currency trading and would they consider it? And one said, forget it. One said maybe, and the other said, you're hired. It seemed like it was a lot easier back then than it is now. So that's how I got into it. And it's really been sort of at the core of what my career has been, for 40 years. I'm a self-proclaimed expert in this space. And I think I've seen, iterations and cycles that, keep repeating itself, but are always very, very different.
That's amazing. And we're not too dissimilar in the way that we got our starts. I got my start at the horse races. I picked the winner at a horse race for my dad's friend, who was a CEO of an FX trading company. So not too dissimilar. Right. Certainly seen a couple of cycles as well in my career as well. That's amazing. I love stories like that. Showing initiative and getting opportunities like that is amazing. So that was obviously the start. Obviously, you've done a number of things since then. Why don't we talk about some of the kind of the earlier successes of your career and what really put you on the map?
Yeah, I think that the market, if you trace the development of the market through the 80s and even the 90s, one thing that was fairly absent from it, although, and it took a while for it to gather momentum, was technology. And so there were constantly dislocations. The system was run through cash brokerage system of voice brokers. There was, significant arbitrage opportunities available between the futures and the cash exchanges, the forward markets. And it really took, electronic broking to sort of begin to tie it together and make it more institutional. It was really kind of a Wild West network. And, it's interesting that because I got involved with providing a little bit of backing to a few early crypto trading firms, and the parallels from what I saw in the 1980s in currency trading to what guys were doing. And in fact, there was a lot of migration from ex-currency traders into the crypto trading world, was very, very similar. There was exchange arbitrage that was measured in multiple percent rather than fractions of a percent. in the crypto space, and there was real critical settlement risk and credit risks that you were taking that were meaningful. But there were a lot of funds that really started in the crypto space on that background. So as I my career developed sort of from a trader to a manager of traders, originally at Bank of America, then to Lehman Brothers. I began to look at the market more as an investor rather than as a trader. And my responsibilities and my outlook on it became more and more fundamentally driven, trying to get a better understanding of the macroeconomics. And I think, that provided me with a little bit, I thought, as a competitive advantage. My background was in economics, finance, international economics. And I think I got the joke half the time, at least, that sometimes took other people a little bit longer. And I think that proved to be a great asset. When I really got to Lehman, I didn't actually get there as the manager of the traders. I managed a group of capital committers managing principal risk for the firm, which gave us kind of a blank piece of paper to wander wherever we wanted to. And wander we did. And I think that each of the portfolio managers that were part of that group had different expertise. Some came from interest rate background, swaps background, others a commodities background, and mine more of a foreign exchange background. And there were others in there. And one of the things that I started to do was get more integrated in corporate finance and larger finance transactions as the firms did. And when I initially got there, I had done some transactions outside of the firm right before I got to Lehman for one of the wealthiest private families that I was an advisor to. And they were doing a lot of investments in Mexico. That was a product of the restructuring of the Brady bonds, or what became the Brady bonds. It was the quasi-defaulted corporate sovereign debt of Argentina and specifically Mexico. And it provided an incredible opportunity, but with what looked like almost a de facto sovereign guarantee to these transactions that were offering incredible risk premia. And smart investors, including the family I was advising, and onto Soros, More Capital, some of the biggest hedge funds, and eventually the proper hedge fund network became very involved in. And there was a flood of money that came into the space in the early 90s, of which I thought that I was slightly ahead of. And we ended up getting very, very involved in building a very big book there. And we actually took an important step, which was sort of out of our natural remit, as we became a market maker for a lot of people in these transactions. So even though we really weren't working as part of that trading business at Lehman, our book and our information and our access to liquidity became so significant that we were being used to offset transactions. So when big block transactions came in, investors came in, we were able to price those things effectively. So what occurred to me, if nothing else, is that in what was a growing emerging market, is that I felt like we had achieved a certain critical mass of knowledge. If nothing else, we didn't have, no one individual is going to move the markets necessarily, but we had a lot of information coming to us from a lot of sources. And in fact, one point we were told, actually by the Central Bank of Mexico, that we were the single largest investor in the country, which wow. From a sort of 5-person group was both, very flattering and frightening.
Do you remember the total amount that you were doing over there? Like, what was kind of like an average position that you had?
Yeah, I mean, I remember for 2 weeks in a row, there used to be a weekly auction of Mexican treasury bills called CETES. And 2 weeks in a row, we took down almost 50% of the entire auction. So, that sort of gives it in magnitude. The total book was large. It was over $1 billion. So it was, these are 1993 dollars. So $1 billion is actually a lot of money back then.
Yeah.
And so, we felt like we had our pulse on a lot of knowledge and a lot of flow.
Yeah, you mentioned something that resonates a lot with me. We believe there are a number of managers out there that have foreign currency as a byproduct, and a lot of the people I think that are going to be listening to this podcast are going to be thinking investment first, currency later. You made an entire living on currency first. What can we learn from you specifically on how you tackle currency problems, whether that be from a hedging perspective or from a speculation perspective, that could be borrowed with these huge managers now that are investing all over the world? Same strategy, maybe credit, maybe private equity, but they're now going into places like Brazil and Nigeria.
Yeah, I think it's important to understand what you know and what you don't know. And, the same professor who recommended I got into this business once told me, you get your bachelor's degree, you learned a little bit about a whole bunch of things. You get your master's, you've learned more about more specialized things. And by the time you get your PhD, you've learned a tremendous amount about absolutely nothing. And I feel like in some respects, my expertise in currencies, sometimes forced me to think too narrowly. And I think that corporate treasurers or anybody who's doing large international transactions kind of have to understand, where they get their information from. Like for me, it was always very important to home grow as much as I could. I had an advisory board of people from the public sector. The former central bank head of Brazil was on my advisory board. Was she the finance minister? Sorry, the former finance minister of Brazil, many years. Was on our advisory board. There used to be a group of consultants that could put together, dinners for 10 people with, ECB head, with a senior Fed official. It became, getting kernels of knowledge to give you small definable edges, I think, is something that we had the luxury of doing, being highly specialized. If you're talking about a corporate treasurer, he's going to most likely have to rely upon someone else to do that for him. And he can either do that passively by having invested in our hedge fund, and we saw some of that. And I'm not plugging that anymore because the fund's not there. Or he can hire people like yourselves, Briggs, who do this both fundamentally and empirically. And you can get to the same place both ways. It's just understanding how you got to that place and how you're using that information. So, I'm very respectful of both approaches and how each of these approaches can analyze data. But you have to understand, what you're dealing with, how you got there, and then how much it matters. If you think of not to go on about this, but if you think about what the present value of any transaction is, it's not only the expected future cash flows discounted by some factor, but it really should be also discounted by expected volatility. It doesn't necessarily figure into most people's formula, but something that is low volatility at a 5% discount rate, if you use that, versus something that has a big currency element that has 30%, standard deviation annually, is that present value is going to be a whole lot less because of the risks associated with that transaction. You need an empirical technology to derive that. You need to understand skew. You need to understand optionality. You need to understand all these things, in combination with the fundamental understanding to get you there.
Completely agree. Couldn't have said it better myself. The thing that we've seen as well is the ability to test this in different market environments, add the skews, add the black swan events that we seem to be seeing more and more of, and being able to stress test this on an ongoing basis. You mentioned passive hedging versus active hedging and dynamic hedging, something that we truly do believe that everyone should be able to ultimately have access to. The problem is when you start that wheel in motion, you can't stop it. You have to continue doing it. And again, if you're outsourcing that or don't have the in-house expertise to do that, you could be opening up a can of worms that you just simply can't control. So it is, it's not a mouthful that you want to be biting in full, right? You have to be careful.
Yeah, I mean, if you want me to provide an epilogue to the Mexico story that should sufficiently scare the hell out of your corporate treasurers, is that late in the process, after I realized there was a big problem in Mexico, and we started, we had the capability. There was no forward market. We had the capability of creating synthetic shorts, which we did across the currency swaps and Brady bonds. Lehman was very involved in underwriting two very large bonds that originated from the wealthiest man, without mentioning his name, in Mexico, had bought two toll roads during the late crises of the 80s that went from Cuernavaca to Toluca and Mexico City. And it was like somebody owning the New York State Thruway. And he was basically cashing out at a 15 or 20x of what he had paid for these rights to the toll road. And he was issuing US dollar bonds that were being serviced by Mexican peso tolls. And Lehman, and these are significant issues. They were $400 and $800 million apiece. And when Lehman was underwriting these, and like I said, the bridge that I had, the corporate finance bridge, I said, this is a problem. And, the risk of default here, even though they were indexed to inflation in pesos, is not trivial. So we packed up a team. We went down to Mexico City, spent 4 days prior to going, developing hedging scenarios, both through forward swaps, vanilla options, second generation options, all sorts of things. Brought it to the underwriting team in Mexico, and I'll never forget this meeting. I went in there, and this gentleman came in, whose name is obviously very familiar, who I don't want to mention now, looked at the cost associated with trying to hedge 2 to 5 year forward peso revenues into dollar liabilities, left the room. His team left. They came back 15 minutes later, and they said, we'd like to take you to the airport. Literally put me in a car, took me to the airport, and I was gone. And back then in Mexico, you didn't kind of argue with that service.
Absolutely not.
And I came back. I was sitting there on the plane on the way back saying, this is going to be a big problem. The hubris and the unwillingness of people to consider the potential risks seriously here. It was just a very big information piece that other people didn't have. And then when that only mattered when things started turning down. And when the issue became about their ability to have enough dollar reserves to keep the peso, which at the time had a peg or a quasi peg to the US dollar, I knew that this would be, a very, very dramatic event, if there was going to be an event at all. And, the rest is history.
Absolutely. So where are the similarities that you're seeing right now? I mean, this is obviously a really specific example with Mexico. You see the younger brother that is Brazil now coming up and really pushing to middle class, attracting a lot of FDI into the region. Inflation is rampant across Latin America, not just Latin America now, around the world. Is there anything that you can see that is similar to back then now? Any opportunities that you're seeing, both positive and negative, short or long? Any of these emerging market regions in particular?
I mean, obviously, it's going to be most acute as it was in Mexico back then, where there's restrictions on capital flows. And I would say, the places that I'm probably worried most about are places like Nigeria, Hong Kong, and maybe, Argentina. That story's kind of been written already. But, some of those countries have allowed a reasonable amount of free flow of capital. And, it's just like a pressure valve. It's like, if your policy is not well supported by your cash flows, like at the corporate level or at the sovereign level, then there's going to be a devaluing of the underlying asset, whether it's your company or your currency, for example. And you can choose how to face off against that. There's either sort of the death of a thousand cuts, allowing for a gradual depreciation of your currency, like you see in Latin America, episodically or like now, or there's the beheading, which is possible in places where you have maxi devaluations in a couple of places in Africa. We've seen it in Egypt. We've seen it in Nigeria. And I suspect we're probably going to see some form of that in Hong Kong at some point in the future.
Any other countries in particular? You mentioned Nigeria, but any other countries in particular that have stood out to you as someone that should be opening up the doors to investment and staying open?
I think that, I'm very bullish on battery technology, whether it's lithium or some of the derivatives. And so there's certainly countries that are involved in, natural resource production, Chile,
Yeah, I was going to say.
for example, and they've got a pretty sophisticated market. They've borrowed internationally. Their dollar debt trades well. It's not perfect, but it's certainly has progressed very far. South Africa is almost on the other side, where their capital markets is better and more sophisticated than what their government has done. If you look at the government's borrowing in South Africa and the quasi-sovereign debt in South Africa, I think there are more problems with it sometimes. But there's nothing else that I would think immediately that I would see is super investable just on that basis.
So we unpacked some of this earlier, but with the US in the situation that's in, with crypto ultimately failing to this point, do you think we'll ever see in the short term a alternative to the US dollar as a safe haven currency? And maybe explain a little bit about what a safe haven currency is, how it tends to act, and maybe compare it to some of the other examples that you've seen in your career as well.
Yeah, I mean, in some respects, it's almost an oxymoron. But when I started my career and when I was first reading up about this, the British pound was considered probably a better safe haven currency. It had just transitioned to the dollar after sort of the debacle of the 70s, moving off the gold standard and everything like that. And I think that there is important for there to be the concept of a safe haven currency, whether it's US dollar or any other group of currencies, if that's possible. I don't necessarily see this being a private market solution. In other words, I think with the Federal Reserve or other central bank being the lender of last resort and having the ability to create currency if it needs to, is a material difference than minting Bitcoin. And I think that there's a lot of use for blockchain, But to go back as whether it is a proper store of value or an effective medium of exchange, I think it could be a little bit of both, but I don't think ultimately it'll be all that. I think there's a great value to be placed in having a trustless solution without friction. And that's a great idea unless something goes wrong. Stuff happens, and when stuff happens, who do you call?
Yeah, straight back. Just go back to mommy and daddy.
Yeah.
With regards to the basket of currencies, a lot of research has been done into the SDR weighting by the IMF and taking kind of a piece from their playbook and determining. I think actually Libra coin was the Facebook currency that they were looking at doing something similar with. We've done some research on it. Do you think? Obviously, the IMF have their own agenda with their SDR weightings. Do you think there's something along the lines there where you're backing it with a fiat currency, central bank, CBDCs, where it's about just ultimately getting in and out of these currencies in a more organized, algorithmic way for the sake of a stable coin?
I like the stablecoin idea, and I don't really know who should be the backstop, in terms of the governance issues for saying, what is this actually backed by? But I think conceptually that works for me. And I think, I know what Circle's done and Jeremy and a couple other agendas on this. And I think that has a quasi frictionless place in finance. So I like that. The SDR is like an egg that's never going to hatch, as far as I'm concerned, in terms of being a meaningful. It's a central bank to central bank tool for the IMF or whoever to create units of liability or asset with, like almost an IOU. And really, if you look at what the financial markets have done in the currency sphere, and if you were to regress overall volatility and determine like how its correlation evolved over the last year or 10 years or 20 years, the market is doing this for us. It's almost creating a basket, and that when certain group of currencies or many currencies are going to be off against the dollar or up against the dollar, whatever. And so do you really need to create a synthetic, basket that's got hard and fast rules that somebody has to maintain, that, has to be defended if something happens, episodically? I don't see it.
Very, very interesting. I think that's a really strong place to end the conversation. I think that was great. Was there anything that you wanted to say that you didn't say, Howard? Anything that you want to leave like the listeners with regards to this cycle of currency risk that we're going through, or currency volatility that we're going through? Is there anything that you'd like to kind of just, do like a 1, 2, 3 on, like, these are the 3 things that you want to think about?
Yeah, I would say, probably the most important thing I would say is that this new cycle and importance of currency volatility and understanding hedging objectives and things like that should not be underestimated. The confluence of interest rate and macroeconomic policies that we had the luxury of living through for the last sort of 15 years is kind of reached an inflection point. And that inflection point will require people to be much more mindful of the exposures that they have, how they're going about quantifying and hedging those. And so, they should employ whatever means they can, internally, externally, to make sure that, the tail is not leading the dog, as it were.
Absolutely.
So, other than that, race or any particular currency or anything like that, it's, I don't know.
I always end the podcast like this. Is there anyone that you would like to thank for helping you get to where you are now? Anyone that we should be having a conversation with and potentially interviewing on this podcast?
I guess it'd be Professor David Marston at the Wharton School. He got me down an interesting path, and just anecdotally, I accepted a job as a financial analyst at Champion International Paper Company in Cincinnati. And it worked out for my girlfriend, who became my wife in New York City, and a potential job at the New York Federal Reserve. I would have ended up in a very different path.
Definitely. You never told me. Did you end up winning the hand at bridge?
The hand? No, I end up losing. Well, I had a very strong partner usually, but what I did win was a lot of free beers.
There we go. All right. Well, I hope you have a great rest of your day. That was amazing. I really appreciated you taking us through that.
Great speaking to you.
Yeah. Take care. Thanks for tuning in to Raise and Deploy, the international investing podcast brought to you by Diaglo, the go-to FX platform for global investors. In this episode, we sat down with Howard Kurz, the founder and CEO of Lily Pond Capital Management. He walked through his time at Lehman Brothers and what followed, how to take into account currency shifts, and what regions seem most ripe for investment. One key takeaway for me is how integral central bank capital restrictions are when deciding which emerging markets you should invest in. Chile, Brazil, and Mexico are currently leading the way here with strong fintech and challenger bank ecosystems. Pakistan, South Africa, and Nigeria are all struggling here and arguably have a lot of work to do. We hope that you enjoyed this episode and are looking forward to the next one. If you or anyone you know has experience investing internationally, we would love to hear from you. Please reach out to us at jb@diaglo.com.